Good day, everyone, and welcome. Today's session brings together two of Jaltech's partners to walk you through their latest investment offering, which is closing within the coming weeks. Jaltech is a tribe favorite at Biz News, with many members having invested across Jaltech's investments. First joining us here today is Jonty Sachs. Jonty leads the firm's growth strategy, identifying new business opportunities, raising capital for the asset management division, originating transactions, and cultivating strategic partnerships. And alongside Jonty is Gaurav Nair. Gaurav is one of the co-founders of Jaltech and jointly runs the fund management division. And Gaurav and his team have been responsible for the market-beating returns delivered under Jaltech's Section 12J funds. Together, they'll take us through the Jaltech Income Opportunities Fund, a spin-off from Jaltech's Section 12J investments, targeting healthy South African businesses that need 20 million to 80 million rand of debt funding. It's a niche that lets the fund earn attractive interest-linked returns from companies that are excellent candidates for structured debt. Jonty, Gaurav, welcome.
Okay, thank you very much for having us.
Should we kick off with the presentation?
Let me do that. Let me share my screen with everyone. Right. Right, is that clear?
I can see it my side. Thank you.
Excellent. Well, thank you everyone for joining the webinar. This is being recorded. A recording will be made available, as will my contact details and Gaurav's. But I think importantly, if you've got any questions, I'm not sure whether there's a chat section. Yeah, there is a section where you can insert the question. Do so at the end of the presentation. We'll go through the different questions and answer them. If you're too shy to ask a question, as I mentioned, the recording will be distributed and you can then just reach out and we can set up some time. But I think the purpose of the presentation it's really to give you a high level feeling and summary around the investment. But again, happy to sit and go through the investment in more detail on a one-on-one basis. So the investment, which is closing in the next couple of weeks, is the Jaltech Income Opportunities Fund. And, as mentioned, this is a spin-off of our Section 12J investment, the Infinity Anchor Fund, which Gaurav and his team have been running for many years. And it's really an opportunity for investors to get exposure to the private debt market in South Africa. And the private debt market is effectively an area of the market where the banks participate. So banks give corporates loans, earn really healthy interest, and those interests we are competing with to give our investors a return. So by investing in this fund, your capital will be used to provide businesses with loans. Interest will be generated and returns will be paid to investors. And initially, diversification will start around 5 or 6 businesses, and as the fund grows, we'll grow that to potentially more than 30 opportunities. But the key attractiveness or the uniqueness of this fund relative to other private debt funds in the market is we've got an active portfolio of businesses that we've provided structured lending to or structured finance to, which Gaurav and his team have been running. And we have this portfolio which will be moving into the private debt fund. So from an investor's perspective, you know exactly where your capital is going initially. These are businesses that have got an exceptional track record with us, up to 7 years, companies that have been paying on time. And with this historic performance, from an investor's perspective, your risk is much lower because we know that the credit in these businesses is really, really good. This investment is an investment for 5 years. Investors want to be invested for 5 years because and I'll demonstrate it shortly, there is a lump sum payment at the end of the 5-year term, but we do have early exit options for investors. So the mindset must be that this is a 5-year investment term. So because the core portfolio or the initial core portfolio is such a central point to this fund, I thought it'd be a good opportunity to hand over the mic to Gaurav, who will take us through the businesses that we're looking to bring across from the Jaltech Section 12J portfolio.
Thanks, Jonty. So the first of the companies I'd like to take you through is a multi-generational family business. And they have been manufacturing all kinds of equipment for garages. And specifically, they also manufacture car washing equipment for cars, for companies that have to wash cars on a mass scale. So, an example of this is a car rental company. Every time you return a car, it has to be washed before it can go out again. Um, and they came to us with some clients, a blue chip rental company that everyone would recognize the name, who wanted to rent out the equipment rather than buy it. And so we helped them fund that investment. And quite important to how we do our investments, a common theme, is they put in a first loss investment, and then we put in the majority of the funding, 80% of the funding. And on top of that, we also structured in a guarantee from the holding company, the company that manufactures all this equipment. Um, and it's been returning quite a good return, just over 15% per annum, for what is essentially a blue chip risk. So quite a safe investment. The next business is a business that does something called floor plan financing. So this is uh, a facility that is made available to car dealerships. Often, when you go to a car dealership and you see the cars sitting on the showroom floor, it doesn't actually belong to the dealer, or the dealer hasn't funded that. Another company has funded these dealerships, and they only they pay interest on it, and only when you buy the car, you actually end up buying it from the company that's funded it. The dealership effectively is just the showroom floor. And so this company had approached us at the time, which is now 5 years ago. They had 20 years of experience. So now they've got more than 25 years of experience. And they had a successful business in this space, providing dealerships with funding. However, they just the way that they had built up their capital base was through a bunch of friends and family. So they came to us, and then we provided capital to get out all the friends and family, and furthermore to align to grow the business. And it's performed very well. We received every payment on time, and the return has been very healthy. It's been an 18% return. And importantly, the security underneath this facility is a bunch of vehicles. And vehicles are actually highly liquid. So if you have a 100,000 Rand car and you discount it to 95,000, you'll move it very quickly. However, our loan that we provided compared to the value of the vehicle is around the 50% mark. With our partners who we provided the facility to providing a bit of funding, and then finally the dealerships providing a bit of a deposit. And so we have really almost 2-to-1 cover in terms of security for the loan we've provided. The third business is a business that does truck rentals to logistics companies, effectively, that need to move around goods. And the interesting thing is that it's the same group of companies as the previous one. And what this group of companies has figured out very well is how to lend against these movable assets. And so that specialty, 25 years in the dealership space, but for 5 years now, they've been applying it into the truck rental space. Again, loan to value of about 50%. And we're looking at providing a 20 million Rand facility here. And then finally, this is actually our counterparty here is a company that is listed in the US. However, they are most of their operations are in South Africa, even though they're NASDAQ listed. And they are extremely high-tech materials business. They produce materials that are used in very specialist products. And So they raised hundreds of millions of dollars of equity, but they use all of this equity for the very specialist manufacturing facilities that they set up and run. And there's a bunch of generic assets, assets that can be used by pretty much by a number of businesses. So generators, solar panels, UPSs, and other types of equipment that can be used more widely. And so they didn't want to use their equity funding for this generic equipment. They wanted to keep the equity funding for the specialized equipment. So we provided them a facility where we purchased the equipment and rented out to them. The return has been 19% to date. And we have a group guarantee from the company in the US. And at the last reporting in September of 25, they had $96 million in cash. So really a strong group guarantee from a holding company, making this quite a safe investment. So in addition to the portfolio of assets, which we have a number of years of experience with, we know the businesses, we know the management teams, we know the industries, and we're very comfortable with them. And most importantly, they've always paid on time, which will be transferred over. We also have a large pipeline of potential deals to do. As it currently sits, you can see it is across a number of different sectors and varying deal sizes, coming to about 500 million worth. And these, not all of these deals will close. Some of them we will due diligence them. It'll fail our due diligence. But this is our active pipeline as we currently sit, really illustrating that there is a good opportunity to make more of these investments in the South African economy. So speaking to how we protect the portfolio, the risk mitigants we employ, typically we take security in the form of hard assets, as you've seen in the deals we're transferring over. And then we're also, within our portfolio, employ concentration limits. And the concentration limit we employ is 15% of, there's an acronym in there, TIA, which is our total investable assets. And furthermore, we'd only do 30% of the total assets in unsecured deals. Typically, we have security, as we said, and geographically, we restrict ourselves to only doing 15% offshore. That's there to allow some flexibility, but by and large, our activities are here in South Africa. That's where our expertise is, our networks are, our knowledge is, so that's the core of our focus. We make sure that there's good loan to values, as you would have seen in the deals that we displayed. And in as much as there's going to be any that the deal's being transferred over, if there's any subjectivity in it, we employ independent experts to do valuations on it. Quite importantly, and what has allowed us to have written such good deals is the investment committee that approves the deals. So we go through a process of doing a due diligence on the deals and structuring it, but then it's presented to an investment committee. And the investment committee for this fund is a joint investment committee between Jaltech and our parent company, Capital Works, and with great credit experience coming from there as well. And that provides an additional level of rigor. And then finally, we make sure that all of the loans that we make out to these various counterparties, that they have covenants in them. So these covenants are measures that the underlying businesses need to meet on an ongoing basis. And that is the amount of cash flow they generate compared to what payments they'll need to make to us. And this allows us to have early flags if something goes wrong and intervene in the business to remedy the situation sooner rather than later. We're focusing on companies with a good track record, revenue of more than 50 million, earnings of over 5 million. Very important to us, an experienced management team, so we're not doing startups, and that there's adequate security. And our sweet spot is transaction values of between 20 to 80 million, and we like to do loans of between 3 to 5 years. So a question that's often asked is, why aren't the banks providing this funding? And the returns are so healthy. So in this space, the space that we're focused on is called structured lending. And structured lending is where the deal has to be constructed, and it's bespoke. It's customized for the underlying borrower. Now, the banks, they're so big that their balance sheets are so big that they only do structured lending for loans of 100 or 150 or 200 million plus. That's the structured lending team. If you need a structured loan, if you need a loan of 50 million Rand, then the bank's business bank applies just a checklist. If you don't meet the checklist, it doesn't necessarily mean you're high risk. It just means that the deal is a bit customized. They can't help you. Ironically, if you needed 150 million Rand instead of 50, their structured lending team would come in. It's high skilled people and it's high touch, and they would structure the deal, and you'd get the deal at prime -1, as an example. So this leaves a gap, an unaddressed area where we are seeing quality businesses, and they aren't high risk, they're just bespoke. And this allows us to come in, do the structured lending, do the structured work, and then provide loans and get high returns, high risk appropriate returns. The risk is quite low. It's just that there's a gap and we're not competing much with other lenders. So this is just a bit of information about our investment committee. The chairman of our investment committee is Rob Katz. Rob is a very experienced executive in the financial services, South African financial services sector. He was a director of Standard Bank. At one point, he was MD of the mortgage division, amongst other divisions. He was then CFO and then CEO of Peregrine Holdings. So a wealth of credit experience, and he chairs the investment committee. Below that, you'll see Rob Odoff. He's also an executive at Capital Works, as is Rob Katz. He was a partner at PwC before he joined Capital Works. And so just great experience in risk and governance, and provides that insight into the investment committee. And then there's myself and Derek, founders of Jaltech. And we've also been on the 12J investment committee. And so we bring all of that specific know-how and experience for these size of businesses and these size of investments.
Thanks, Gaurav. And I'm going to, over the next couple of minutes, just take attendees through the investment opportunity. For those of you who joined a bit late, this is being recorded. We will distribute the recording, as well as my contact information if you want to meet one-on-one. But if you do have any questions, there's a chat section. You can put in your question at the end of the presentation. We'll answer those questions. So for investors, we've got two investment options. I'm going to go through them, but just a high level. The first option is for investors who are looking for annual dividends, and then a lump sum payment at the end. And the second option is for investors who don't necessarily want annual distribution. They want a lump sum payment at the end. And the second option, the returns are much higher, but it's risk adjusted. And I'm going to take you through the risks over the next few slides. So the first option is a pref share option. Investors invest. They receive annual dividend of 8% pre-tax. This is paid every single year over the 5-year term. It's not guaranteed. And then at the end of the 5-year term, we value the portfolio. So what happens in these type of private debt structures is you raise capital, you put in some debt, the portfolio starts to perform. Some of the capital or profits is used to fund other businesses, and as you fund more and more businesses, the loan book becomes larger, and there's a lot of value in this loan book. So what we do at the end of the 5-year term is we value it, we refinance it, and investors in this share class, they receive 30% of the growth of the portfolio, and that then equates to a lump sum payment for them at the end. But if we take the dividend distribution and the lump sum payment, if we had to spread it over the 5-year term, as an investor, you're looking to achieve, or we're targeting to return 12 to 14% per year after tax and after fees. But in addition to the benefit of the distributions, investors in this share class, they have 40% downside protection. So initially, we're raising 100 million rand. There's 10 million rand in this share class remaining, and there's 10 million rand in the next share class remaining. Our fundraise is nearing the end. But these investors in the pref share, they have capital protection for the first 100 million rand raised. And what this means is, and the capital protection is capped at 40%. So if we raise 100 million, we finance businesses up to 100 million, and let's say 3 years later there's an impairment and we need to sell the entire portfolio, and we sell it for 70 million. So we've lost 30. Investors in this share class, they won't lose anything because their capital has downside protection up to the first 40%. When the fund grows, and let's say it grows to 200 million, their downside protection will drop from 40% to 20% because of the fund's growth, and the fund's now more diversified. So investors don't need that additional capital protection. From an IR perspective, internal rate of return, pre-tax, it's at 15%, and after tax, the return's at 12%. Now, you might see there's a very small difference between pre and post-tax, and that's really because of the structure. Investors invest into this fund as they become shareholders, and they receive a dividend distribution. Dividends are taxed at 20%, versus other private debt funds where investors receive income and are taxed at 45%. So there's a benefit there for investors. So there will be debt added to the fund, initially at really low levels, and over time potentially growing to 1 to 2 or even higher. But just to give you a visual, if you invest 1 million rand, the target is to return on average after tax and after fees 120,000 rand per year. So quite meaningful returns. The second option is what we call a super pref. This investment does not pay a distribution during the 5-year term, but investors in this share class participate in 70% of the growth of the portfolio. But because they're taking up the majority of the growth of the portfolio, their capital is used as the first loss tranche. So if the investment, in the example I gave, if we finance 100 million and we sell the portfolio for 70 million, that 30 million rand loss is really borne by these investors. But for that risk, you're getting 70% of the upside. And just to remind investors, and really what Gaurav explained earlier, is the first 100 million rands worth of opportunities are companies that we know, businesses that we've been providing structured finance to for up to 7 years. So these are, in our view, quite low risk financing arrangements. The internal rate of return is high. It's 25% pre-tax, 22% post-tax. Pre-tax, that's 3 times your money. Pre-tax is 3 times your money. Post-tax, it's 2.68 times your money. And just to give you a visual, on a 1 million rand investment, we're targeting to return, in addition to the 1 million rand, just under 1.7 million rand after fees and after taxes. So 1 million rand in, and you're effectively getting just under 2.7 million rand back after fees and taxes, which is really impressive return. But it doesn't come without risk. So, with this investment, one is deployment risk. So if we aren't able to find enough businesses to provide adequate loans to, returns will be affected. If we provide loans and these businesses don't pay, well, returns will be impacted. It's a private credit fund. As the portfolio grows, we are reliant on more debt from our debt provider. We think it won't be an issue, but at some point they might decide not to provide us debt for whatever reason. And then there's obviously debt risk. If the underlying businesses don't pay us, well, the bank's going to want their money back, and they're going to require us to sell the portfolio, potentially at a loss. So it's important to be mindful that this investment is not without any risk. I think we're going to move on to questions. So let me stop sharing my slides. I'm not sure if there are any questions, but as I mentioned earlier, if there aren't, or if you'd like to rather have a one-on-one, my details will be made available, and we can have a Teams call.
Thank you so much, Jonty. Thank you, Gaurav. Yes, as Jonty mentioned, there is a chat functionality and Q&A functionality there. If you have any further questions, we'll just spend a few more minutes answering those. So feel free to raise any queries or questions, or if not, reaching out to Jonty afterwards.
So some of the questions which frequently come up with investors is, what happens if during the 5-year term, I have a personal event and I need my capital? So what we do is the option for investors is they need to give us notice, and we ask for 6 months notice. And then this will go to our investment committee for approval, or our board for approval. But what's important is investors who need to exit early, what happens is they have to then forego the lump sum payment at the end. And for both of the share classes, there's significant upside for investors to be in for 5 years. But we do understand that personal events do occur, and we'll, provide investors with liquidity where we can.
Thanks, Jonty. I see there's a question from Devin. He says, your first slide indicated a minimum term of 5 years, yet you stated a lump sum payout in 5 years. Please clarify.
As I was mentioning, investors need to be in for 5 years. It's a 5-year investment term. This really coincides with a number of the ways in which the team structure the loan arrangements. And we then, at the end of the term, will then value the portfolio or refinance the portfolio in order to provide liquidity for investors. And that's really how we exit investors.
Thanks, Jonty. A question from Stuart. Thanks for the presentation. I missed the beginning. What is the minimum investment amount?
Actually, I think your connection is not great, but I did hear the question. So at the moment, the minimum investment is R1 million. However, our prospectus, which is a legal document which we have to submit to SIPC, that will be hopefully approved next week, Friday. Once it's approved, the investment minimum goes from 1 million rand to 250,000 rand.
Great. Apologies for that, Jonty. A follow-up question from Devin again. Are there conditions to be met for annual and the final lump sum payout?
So there aren't any conditions to be met other than the fact that the fund needs to perform. So assuming the businesses that we are already providing structured finance to continue to pay, well, then investors can anticipate their annual distributions. But if we have an impairment, and what I mean by that is if there's a default for whatever reason which impacts the returns on the fund, then distributions potentially may not occur. I think what's important for these investors to know is they're preference shareholders. So other than our debt provider, they are the first to be paid when distributions are made. So that they rank preference to other shareholders. And for the lump sum, exactly the same. So as long as the portfolio is performing, as long as we've built value, which we believe we can easily do, investors should then receive that lump sum. And the condition, I think, effectively is when they are exited. So a refinance will take place, and liquidity will come in through the refinance, and the investors will then receive their payment. I hope that answers the question.
That's great. I see there aren't any more. Thank you, Jonty. Thank you, Gaurav, for your time. The Jaltech Income Opportunities Fund. Thank you both.
Thanks, directly.
If there are any further questions, if there are any further questions, please do reach out to Jonty on his email, as he mentioned before, and looking forward for more. Thank you.
Thanks everyone.
Thanks, everyone. Bye-bye.